if you were attending and viewing the November MIF, you'll recall that I was pretty bullish about gold then. You'll note that the date of MIF in November is that blue line, which happens to nicely coincide with the peak in gold prices in the last several months. So I didn't get that one quite right. As it turned out, and this is really what this talk is about, we're in this transitory situation now where the Fed and other central banks have clearly shifted from being 100% accommodative to not really pulling the punch bowl away, but getting less accommodative, trying to respond to higher growth coming out of COVID, but obviously more to the point, trying to react to higher inflation that's been going up at an increasing rate through most of this year and came as a surprise to pretty much everybody in the central bank space. That's made things a lot trickier because the Fed keeps moving goalposts. They've kept talking about more and more tightening over the next 12 to 18 months. They went from probably not tapering to probably tapering and then actually starting to sell bonds, which is quantitative tightening as opposed to quantitative easing. They've shifted a lot in the last couple of months, and that is a big part of the reason for the impact you see on the gold chart there. It sort of came apart going into year end, pretty much right after the last MIF, and that was really based on Federal Reserve messaging, really kind of spooked people. The problem is that this is an issue that's going to be with us for some time now. It's probably going to go on for a few months because it's going to take a while for the bond market and the Fed, and by extension, the equity markets, because I think really the bond market rules the roost here. They have to come to sort of a new consensus, if you will, a new paradigm. That paradigm has to match up, hopefully, to reality, to what the Fed's actually doing. And when you get to that point, things tend to settle in. And if you go back and look at periods of extended Fed tightening, those periods generally were, in fact, periods of higher gold prices, higher base metal prices. Commodities tend to do quite well during those periods, because almost inevitably central banks are behind the curve and real rates stay negative. But what we're dealing with now is not so much the actual real rates and the actual interest rates. We're dealing with perceptions of how those are going to change going forward. And until that settles into some kind of a sort of a base case paradigm that everybody agrees on, we're going to see a lot of volatility. I just threw up this 1 year chart for the 10-year. This is a nominal 10-year treasury yield. You can see that as inflation kept rising and as at the Fed, both in Fed meetings, but also Fed minutes that got released later, and also in congressional testimony in the last month or so, started getting a lot more hawkish. You can see the impact that had on this side of the curve. There was just another real step up, and that really kind of put the brakes under gold for a little while, although it started to get a little bit more life into it later. Part of the reason why gold sort of still starting to come back a bit is there's still this real lack of consensus about what interest rates and inflation are going to do together, which is to say the bond market's perception, especially of real interest rates, it's all over the map. It's up one day, it's down the next, it's up the next. And I think we're going to see this for a while. One of the things that was interesting to note is if you think of the previous slide where you saw yields going higher fairly quickly there in the last month, you would expect that what that would do is lead to much higher US dollar prices. That's not, it's not surprising. That makes a lot of sense. If you look from November into December, really from June to December, the US dollar had a pretty good climb. It kind of flattened out at the end of November, and it had a pretty big dive. And this big dive you see on the right side, that's actually when the latest inflation numbers came out. That was the day it really got whacked. And I think the reason for that is that you've got traders in the currency markets now rather than the bond markets concerned that maybe the Fed's not going to keep up as much. Maybe real rates are going to be low enough that it's going to be sort of a negative for the dollar in a pair trade against anything else. Alternatively, and I think we're probably looking at both of these explanations, you may have currency traders looking at inflation rates not coming down, getting worried the Fed's going to get more and more aggressive, and then that will in turn hurt U.S. growth. Part of the reason why the dollar's been so strong through the last year with U.S. growth rates are just so much better than everybody else's, there may be concern that that's going to start coming back if the Fed really starts pushing on the brakes. I think the jury's still out, honestly. I don't think we're going to know until the numbers are out whether the Fed's going to have that impact. But going back to gold, and you can make this argument. I mean, gold is the obvious argument. It's the one that gets talked about all the time when we talk about real rates. But generally speaking, you can make exactly the same argument for copper, for nickel, for oil, for any commodity. Generally speaking, when central banks are behind the curve, which means interest rates are lower than the inflation rate, and especially if you've got an increasing inflation rate, that's good for commodities in general, but it's particularly good for gold. If you look at this chart, I mean, the inverse relationship between gold prices and real yields it's pretty amazing. It's an extremely strong one, and it's the reason why I keep harping on it all the time. But it's also worth remembering that it's not always just a matter of, you can't just look at inflation or interest rates. You got to look at the interplay. If you look at this, for instance, you look at this big spike in real rates during the Great Recession. That wasn't because interest rates were going higher. Officially, obviously, the Fed was cutting things and throwing everything but the kitchen sink at the market. Then that was because the inflation rate cratered. That's what drove the real rates up. So you're always looking at the two things together to get to a real yield. And you can see here as we move through 2020, 21 into 22, there's a lot of zigging and zagging here because there's been a lot of movement in perceptions of future forward interest rates, but also just a lot of movement in both directions and a lot of movement in perceptions of what inflation will do over the next 2 or 3 years. That's the reason why you see this bouncing up and down with the real rates, and conversely, the bouncing up and down with the gold price. I think we're probably going to see this for a while longer. I don't think this is going to go away right away. It's going to take at least, I would think, a few months for some sort of consensus to settle in. That doesn't mean gold and other metal prices can't go higher. It just means we're probably going to get these big swings when new data points come out. We've been seeing that, especially in the last 2 months. There's been a lot of swings up and down as a new Fed minutes came out, new inflation numbers came out, and we're going to see that for a while. That's just something we're going to have to live with until the market settles in again. Higher inflation, I am absolutely in the camp of, some would say cynics, but I think I'm being realistic. That says, in a perfect world, if the Fed and every other central bank could pin inflation to 4 or 5 or 6% and keep it there, they would do that in a heartbeat, because all of these central banks are dealing with oppressive, gigantic mountains of debt. The only realistic way to get rid of that is to inflate it away. That's how they've done it in the past, and that's how I think they're ultimately going to do it this time. There's no way when you look at the debt burdens of the U.S., Canada, the EU, all of them, Japan. It's the same everywhere. There's no way you can deal with it at a fiscal level. You cannot cut spending that much and or raise taxes enough to get anywhere near dealing with the problem. Like, you just can't do it. It's political suicide, and frankly would be economic suicide at the same time. The only way this is going to happen is if these get inflated away. The problem is that once these inflation moves start, more often than not, they get out of control. The central bank can't deal with them. They end up doing more rate increases than they planned to try to stifle it. And that's where the central bank mistake comes in. That's where the overshoots come in. I'm not saying that's going to happen this time. I'm not totally convinced it will, but every time you see an interest rate transition and a move to higher rates over a 2 or 3 or 4 year time span, there's always danger of an overshoot. It's almost inevitable that central banks will do 1 or 2 too many rate increases. I don't think the 3 or 4 we're talking about is too many, but it explains why they have to try to tighten this. And the other reason, and it's displayed in this chart, the chart on the left, on your left, is this is retail sales. This came out this morning. The one on the right is real wage growth in the U.S., not nominal wage growth, real wage growth. This is important to the Fed. Both of these things are. You can see this dump here. It was much worse number than expected this morning. Some of that's probably Omicron, but I think some of that is just consumers maybe tightening their belts because of this. You look at this number here, real wage growth has gone from 3% to negative 1.5%. I think that, I suspect this chart surprises a lot of people, but unfortunately, inflation's moved a lot faster. So in real terms, in real, pocketbook spending terms, wage growth has turned negative in the last couple of months. I don't know when this gets resolved, whether inflation has to come down 4 or 5%, or whether we have to see bigger wage increases. But this is a real potential problem going forward. Keep in mind that in the G8 economies, they're all about consumer spending. That is the economy. So if this problem gets worse and we start seeing spending really tail off, that's going to be a big problem. I'm glad I'm not in the Fed's or the ECB or the Bank of Canada's shoes, because this is not going to be an easy problem to deal with. This is a very tricky situation. Even though you're not seeing in the equity markets, you're not seeing much news or headlines about it. This real wage growth is a big problem. One of the biggest surprises, I think, to a lot of people, and maybe the bond market is looking at things like real wage growth. Really, if you look at it, if you step back and look at it and you go, well, inflation, the last inflation reading was 7%. 10-year yields right now are about 1.8%. Yeah, that's a big move from a few months ago, but it's 1.8%. Like, what the hell? Why aren't bond yields way higher? Why aren't we looking at 5, 6, 7% bond yields? Forget what the Fed's doing. Where did the inflation hawks go in the bond market? They seem to have disappeared 20 years ago. I think there's a couple reasons for that. I mean, if you look at this is a very recent chart. It basically just shows you what the bond market is pricing in as of a few days ago. I think as of today, I think this fourth rate increase is actually priced into the end of this year. So, I mean, those are four increases in 1 year after several years of either cuts or no increases. So, in a sense, the bond market is pricing in that much aggressiveness by the Fed. Clearly, the bond market doesn't believe they're going to be more aggressive than that. If they did, rates would be higher already. But I think the other thing that may be impacting it, and we're not going to know whether this chart is BS or not for a year, is this chart here is the consensus economic forecast. Bloomberg collects these up from like hundreds of economists and averages them out. The blue line is a consensus estimate of this year's inflation rate. And this chart is sort of going left to right from the beginning and the end of 2021. So as we get close to the end of 21, the estimate for this year's inflation went from basically 2% up to 4.5%, 5%. It's probably higher now after the last inflation reading. But if you look at the 2024, sorry guys, if you look at the 2024, the red line, it's done not nothing, but pretty damn close to nothing. What that tells you is the consensus on Wall Street economists is inflation is in fact going to be transitory, that it's going to go back to about the 2% level by the end of this year. I'm not sure I buy into that. Honestly, I'm kind of on the fence. I think some of it definitely is transitory. You will see natural declines in inflation as some things top out, like energy prices. Hopefully a couple of things like that. As that curve flattens, that will bring down the inflation rate. I'm not so sure about this 2%, though. That seems pretty optimistic. But if that's the way the bond market's reading it, that helps explain why you're not actually seeing higher bond yields, why bond traders aren't basically selling the crap out of everything right now, looking at 7% interest rates. And, for all of our sakes, we kind of have to hope bond traders keep thinking that way. I don't know where the bond vigilantes went, but I'm kind of hoping they don't come back, because this would definitely not be a good year to see the bond vigilantes come back. It would definitely screw the whole market up badly. Going outside of gold, going to commodities in general, it probably doesn't feel that way to a lot of us, but I mean, hey, we're resource stock investors, we love to whine. But if you look at this chart, it's kind of amazing when you look at this chart and you see how strong and significant the upward move is from, basically the March low during COVID last year to now. We're back to about 2014 levels. I think maybe the reason a lot of resource traders aren't jumping for joy is 2014 wasn't that awesome for this space, as I'm sure most of you recall. But it is important to remember 2014, we were several years into an extended downtrend, and it was clear the downtrend was going to continue for a while. now we're a couple of years into an uptrend, and fingers crossed that uptrend is going to continue for a while. These graphs are fairly heavily impacted by oil and gas prices. That's a big part of the reason this looks so strong. But really, it's been pretty good for base metals all around. These are current charts of, I would say the four main base metals if you work: copper, nickel, zinc, aluminum. These are 5-year charts, and there's really, to my mind, I'm not a TA guy, but there's nothing not to like about these charts. I mean, all four of these look very strong. Copper reached an all-time high. Zinc was pretty close to, I think I might have hit it all. I think that might have been an all-time high, that spike late in 2021. Even aluminum has been very strong. Nickel's been, nickel had a crazy run back in the aughts, so it's going to be some time before it sees an all-time high. But $10, which is where it's sitting right now, is better than it's been for a very, very long time. So I don't think there's much to worry about with base metals. I'm very bullish about base metals longer term. One thing I would say, though, some of the short-term price move is definitely supply chain issues. In the case of base metals, the supply chain that's the issue is power. There have been rolling power outages in China. They've had a lot of trouble keeping their grid up to the demand that just grows so quickly there. Plus China, ironically, I mean, people don't think of it this way. China has done a lot of work adding renewable energy resources. And as a lot of people are finding out in China, and especially in Europe, those really aren't baseload things. They're not that reliable. That's been a big problem. The problem that you've got in Europe is they made in my opinion, very big mistake of, in several areas, cutting out the nuclear power, which was the baseload. Now they're basically living off of Russian gas. Gas prices have gone crazy in the last 3 or 4 months, like completely crazy, up 200 or 300%. That's a big impediment. Smelters are extremely high power users. It's probably, in terms of the value of its output, it's probably the highest power usage of any sector in the economy. These power costs are killing these guys. In China, you've had smelter cutbacks simply because essential authorities have just said, smelter A, smelter C, smelter D, you got to shut down for a week, or you got to run one shift because we can't handle the pull on the grid. In Europe, it's simply a function of power costs, and a lot of smelters, a lot of big industrial users don't have long-term power contracts. They're buying short-term power. They're often going into the market daily to buy power. Those short-term prices have gone so high, it's basically just killed the economics of a lot of these smelters. So that's been a big help. It's been a big help if you're trading this stuff, because it's made all of these base metal prices that much stronger. I haven't talked to any producers yet that have actually had to cut back or had smelters sort of telling them to back off with shipments. That may happen if this whole power and grid thing goes on long enough. But for now, it's just another positive for metal prices. And even though I think that will hopefully ease off, because it's a big problem, not just for smelters, for everybody. Even if that eases off, I think we still, longer term, we've got this bullish case on the supply side, because as everyone in the mining business knows, every year that goes by, there's more permitting, the timelines get longer, ESG stuff is huge, reducing power footprints for mines, all of this stuff, your good old NIMBY, none of this stuff is going away anywhere. If anything, it's spreading to a bigger and bigger number of jurisdictions. So that's just an issue we have to deal with. It's going to take longer to get things into production, but again, that's better for people in the discovery and development phase, because it'll keep prices high. So longer term, I do think we're going to see an upward move in precious metals. I do expect the market to reach that equilibrium where the bond market, the Fed, the equity markets all go, yeah, okay, it's going to be X rate increases over Y period. It's all good. Real rates will be negative through that entire stretch. And that's when I think you see gold just kind of walk its way back up through $2,000. I think that's coming. I don't know whether it's going to be in a month or 3 months or 6 months, but I see that part of the cycle dead ahead of us. If the economists are right, and I think they're half right, I personally think inflation is going to ease as we go through 2022. I don't think it's going to go back to the 2% they're talking about, but I think it is going to go back. And remember, as inflation eases, real interest rates rise. So the whole thing with precious metals in particular, it's not going to be a straight line. They're going to be all over the map the interplay changes between those two things. Whenever the Fed starts tightening, there's always danger of an overshoot. Right now, they're talking 3 or 4 increases. I find it very hard to believe that would be enough to generate an overshoot. But this is not a normal market, so honestly, who the hell knows? Market relationships are very different. They're very unusual. They're not like anything we've ever seen before. So until things sort of normalize again, expect the unexpected, I think would probably be my bottom line thesis. But I do think the outlook is generally positive. We're just going to get these big zigs and zags occasionally. We're just going to have to live with it. That's how it is. But I still think this is going to be a pretty good year for this stuff.